Welcome, Accounting Boffins. You are with Ashraf Patel, and our topic for today is budgets. Now, obviously, the first question that everybody would ask themselves, have you ever thought of this? How would you spend R1,000,000 in a month? Obviously, we'd love to do that, but definitely when you receive that type of money or you have access to that type of money, how would you spend it? This means, therefore, that you have to draw a budget. Now, that is why we say in accounting that our subject is a life skill. You may not study it at a tertiary institute, but it's going to impact on your personal life. In other words, look at the different types of budgets that you have. You're going to have a personal budget, and whether you're doing it consciously or subconsciously, each one of you out there, you're drawing a budget every month. From your allowance, you have to determine what can I spend, what can't I spend. In this way, you can see that there is, you may not have it written down, but there is a budget in place. So each one of us has a budget. Whether we stick to the budget, that's a different question. Okay, so you also have a household budget. You have a business budget, right? Can you see the different levels of budgeting? And then obviously, not very long ago, we had the national budget. Okay? Now that is where the country's budget, obviously, they also have to draw up a budget. So if we have to summarize now, and we have to ask ourselves, what is a budget? A budget is a tool that we use for projections. In other words, we forecast whether we can comply with the budget. Obviously, that's a different matter, which you will see as we go along, where we compare the actual with the budgeted figures. Right, so now, where's our emphasis? Definitely the emphasis is on the cash budget. Now, what are important words that you need to know? What terms are important for you? One, all of this falls within the ambit of financial planning. Clearly you can see you need to have a plan in place, because if you do not plan, then definitely that is a recipe for disaster. You have projected figures, right? You'll see later on in our further lessons, we'll talk about the projected income statement. There we will look at projected. Remember something, you are forecasting what you expect to happen. Now, all of this is not done as a thumbsuck. No, it is done with proper planning in place. So by the same token, you're going to look at your projected expenses, and in this way, you will then draw up your budgets. Now, and remember, you get different types of budgets, but we'll get there. So, what is a budget? A budget is a plan, right? And what is this plan? How much money do you expect to receive? In other words, what are your projected receipts? Okay? So you plan and say, okay, if you're looking at your personal budget and say, okay, fine, I'm getting an allowance from my dad. My mom gives me a certain amount every week, and I have a part-time occupation where I assist, and I get paid for working in the garden. All of those would be your receipts. So those are what you projected, okay? This is what I anticipate to receive. By the same token, how will you pay it out? What will you spend it on? I'm going to buy, very famous for you guys, data, isn't it? I'm going to buy whatever my needs are. I'm going to spend on that. And there what are you doing? You're actually drawing up a budget for yourself to say, these are my expected receipts and these are my expected payments. Watch the use of the terminology here, because it's very, very important. Okay, We spoke about this. We said, in your personal budget, what are you doing? Looking at your expected earnings in a month. In other words, what do I expect to receive in this month? And I gave you examples of what the possible incomes that you may have in that month. And then obviously, how are you going to pay? What expenses are you going to have for that month? But remember, when we're talking about a cash budget, right? We're talking about expected receipts and expected payments. And that is critical. So now, when we're looking at a business, let's move on now from our personal lives to the business. A business definitely needs a plan. So, all of this would fall within the ambit of planning and forecasting. In other words, this budget that the business draws up, once again, it's based on evidence. It's based on prior information. So it's just not something that you just decide, okay, there's the plan, and we'll just decide that we're going to... No, these figures are calculated based on previous experience, based on circumstances in the economy, etc., etc., etc. So, it shows you, or it indicates your business activities. So you're drawing up a budget. Are you drawing up a budget for 3 months? Are you drawing up a budget for 1 month? Are you drawing up a budget for the year? Those are the different periods in which you are planning for. Okay? Then, your budgets are expressed in terms of what? Obviously, you need to quantify the budget. In other words, you express it in terms of rands and cents. This means, therefore, that you are looking at the actual amount of money that's going to be paid out. So, I'm expecting my payments to be 15 million rand. Or you can say, I'm expecting my receipts to be 32 million rand. So, you're putting it in rands and cents. Now remember, that's the budget that you are drawing up. What do you base this on? Like I said early on, I alluded to this just now, and I said, these are based, your forecasts are based on sound judgment, right? Obviously, your financial team would sit together, and those involved that are with the budget would sit and bring the information to the table so that you have the professionals doing it. 2, you take into account patterns or tendencies during the previous year. So obviously, you're looking at last year, you're looking at this year in comparison to last year, and you're telling yourself, okay, this is what I expected, this is what actually happened, how do I plan ahead for the next year? So, you look at the anticipated market conditions. What do you expect will happen in the market in the next year? So obviously, these are things that are not static. They are dynamic. They change. Market conditions changed. You'll notice that at certain times, the demand for products and services just increase. And at times, there is no demand. So you'd look at whether there's a boom in the economy, whether the economy is going into depression. All of that would impact on your budgeting decisions. The current economic climate. Obviously, it's important to look at that to see, are they anticipating growth in the economy? Are they expecting the economy to contract? All of that would impact on your judgments when you are drawing up the business budget that you are involved in, right? You also look at technological developments. In other words, what's happening on the technology front? How is that going to impact on my business? All of this would impact on the decisions that you are going to take. And remember, those decisions are going to impact on your business, right? Then you look at economic measures. You look at, for example, the repo rate in the country, you look at the interest rates, all of those decisions, you can see it's a holistic approach where you take all of these factors into consideration when you are drawing up your business budget. Okay, now we look at the national budget. Obviously, when the national budget is being drawn up, they take into account the Minister of Finance and his or her team would look at the economy of the world. Can you see the scale at which it's drawn up? Obviously, the budgets, like I said earlier, are presented by the Minister of Finance, right? They determine economic policy related to government revenue. That means, where is the government expecting to get its money from? Obviously, in the form of taxation, direct taxation, indirect taxation. You get pay as you earn, you get VAT and excise duties. There's a whole lot of taxation that the government uses to collect revenue from its citizens. Then obviously, how is it spent? Where is this money spent? So when the national budget is drawn up, they look at the sources of revenue and they look at the expenses, and obviously you have to play the balancing act because you have to balance the budget. I'm sure you've heard that term before, even at home, where your father or your mom would say, listen guys, we need to balance the budget. Meaning, look at your revenue, look at your receipts, look at your payments, and obviously certain, sometimes tough decisions need to be made. So this is just an example for you of a national budget. Now you can see, historically, it goes back to 2017, 2018, right? And you can see they projected right up to 2023, 2024. Again, what are we looking at? Watch this here. This is important. You're looking at revenue. You're looking at expenditure. You're looking at your budget balance. Can you see? Obviously, you can see from this here that the budget needs to balance. Remember I said that? Balancing, to play the balancing act. Here you can clearly see it. That, again, what is important for us to take note from this national budget is that you look at the past and you look at the future. And based on that, you make your decisions. So therefore, if we now have to summarize and look at all the aspects that we've dealt with so far, what did we say? A budget is a planning tool. It is something that a business would use. One is drawing up the actual budget. However, to put it into operation is very, very important. So it's just not putting it there and leaving it aside. No, you refer to it on a continuous basis. Just to give you an example, you anticipated to spend, say, 15,000 Rand on the telephone bill in that particular month. What happens now is you go into your budget and you say, okay, expected payment for telephone bills is 15,000 Rand. You now go in and you check your actual expenditure, and you find that the amount that you have spent is 30,000 Rand. You spent double the amount. Obviously, the alarm bells start to ring, because now you've budgeted an amount of 15,000 Rand, but you've actually spent 30,000 Rand. So clearly, that particular expense needs inspection. So you look at it and say, okay, fine, what is going on? Okay, you look at the conditions. Now, there's no correct answer here. You look at the conditions and you say, okay, the company embarked on a massive telesales project. Okay? So obviously now, yes, it was not planned for. The needs of that particular month demanded us to increase the usage of the telephone, and as a result, it went above the budgeted amount, which is not a bad idea, although you've overspent the budget. This means, therefore, that you need to revisit and say, okay, why did we respend? Why did we overspend? it means we've spent too much, but because of this campaign, it increased my sales. So this is just one example of how you would compare your actual budget with the actual figures that were paid out. So this is just an example, right? So then we spoke about the personal budgets, we spoke about household budgets, business budgets. We also give you an example of the national budget. And if we have to summarize all of this, budgeting is a planning tool which the business needs to use in order to maximize the profits. Don't go away, guys, because when you come back, we're going into more detail with regards to budgets. See you just now. Welcome back, Accounting Boffins. You're with Ashraf Patel and the team. We're looking at budgets. We're moving on now to, yes, a cash budget. What is a cash budget? Now remember, the emphasis in grade 11 would be on the cash budget. Obviously, the other budgets would impact on your cash budget, but for you, your goal is the cash budget. Okay, so now, a cash budget, what does it do? It shows you estimates of future receipts and payments. Now, allow me to explain this very clearly. When we talk about a cash budget, we're saying anticipated receipts. Clearly, this gives you an indication that you're only talking about cash items. So when you're doing a cash budget, you think cash. Mula, cash, right? So, by the same token, when we're talking about a cash budget, we talk about cash payments, only cash payments. Guys, I'm emphasizing the word cash because remember, we are dealing with a cash budget. Okay. Why do we draw up the budgets? We said budgets are drawn up to help management be aware of any potential shortages or surpluses of cash resources that could occur. Now remember this, we're talking cash. Very often you would find that a business may have millions in assets. However, they could experience a cash flow problem, meaning the cash budget is not in sync. And that is why we draw up a cash budget to ensure that we do not face a situation where we have either a critical shortage of cash or we're sitting with massive surpluses. That is also not acceptable, right? So basically, like I said, you strike a balance, and therefore, based on that balance, you ensure that you are able to meet all your payments with the cash that is available. What does a cash budget deal with? It deals with items or transactions dealing with cash. Now you would think, why are we emphasizing this point? Because you will clearly now see that any non-cash expenses are not included. So now, let me ask you for an example. Can any one of you tell me, give me one item that would not appear in your cash budget? Think. Remember, you're in grade 11 and you've been exposed to these expenses the entire years, in fact, from grade 6, 7, 8, 9, and 10. So let me give you an example and show you an item like depreciation. Right? The question is, would depreciation appear in your cash budget? And the answer is an emphatic no. Why? Because depreciation does not involve the flow of funds. Yes, it is an expense. Yes, it is an expense. And if you refer to our other lessons on depreciation, you will remember we said that depreciation is an imputed expense, an expense that does not affect the flow of funds. Right? Think of another one. Bad debts. Yes, it's an expense, but it would not appear in your cash budget. Reason, it's a non-cash item. So, focus, cash budgets, only cash items. Think cash when you're doing the cash budget. How do we manage the budget? What do we do with it? Like I alluded to early on, well and good, you've drawn up a budget. How do you manage it? So firstly, a budget should be checked and adapted regularly, right? Sometimes, if the need arises, you may have to adapt it once a week, just depending. So obviously this tells you that if you're working on a monthly budget, at the end of the month, monitor the budget, compare your budgeted figures with your actual figures. And then based on the evidence in front of you, you now have to make certain adaptations. You need to change certain things that are necessary to be changed. What are the important functions of a budget? One, it is a planning tool, clearly evident from what we've done so far. Number two, it coordinates. That means bringing into all the components of a business. It's coordinated, it's bringing in, so you can see, okay, from the sales team, the sales budget, what's happening? How's it impacting on my cash budget? From my purchases budget, how is it impacting on my cash budget? Because certainly, those other budgets are going to impact on your cash budget. And yes, it is a controlling tool for what? Your receipts and your payments. All the monies that are being received and all the monies that are being paid out. You can actually see that in your cash budget. So, guys, a cash budget, it is imperative that when we draw up the cash budget, we take all these factors into consideration. Now, let's look at specifics. Let's look at specifics now. If you were to look at the cash budget of a business, what are the possible receipts? Let's go through them. Number one, obviously, your cash sales, right? Because obviously when you sell goods for cash, money is flowing into our coffers. So that's a receipt. Then you have collections from debtors. Clearly, if you have sold goods on credit, those debtors are going to pay you at some time. So therefore, that's another possible source of cash, the monies that you are receiving from your debtors. You could also, remember in grade 11, where we do asset disposal, when you are disposing of your assets, that amount of money that is being generated would also be regarded as a receipt. You look at incomes from investments, for example, if you've invested money into a fixed deposit, the interest on the fixed deposit would also be seen as a source of cash. And also taking into consideration, when a fixed deposit matures, that money is also flowing into our bank account, so that's also a source of cash. And then yes, if you are receiving loans, right, money is flowing into our bank account, so these are all our receipts. In other words, these are the avenues where money is flowing into our bank account. Right, now let's look at our payments. Obviously, you got to pay your creditors for the goods that you are buying from them. You have to pay your operating expenses like water and electricity and all other operating expenses. You get investments. That means if you take money out of your bank account to put into a fixed deposit. Be very careful on this one here. One is money taken out of your bank account, put into a fixed deposit. It's an outflow of cash. But a fixed deposit maturing is money that is coming into our bank account. So be careful and be able to determine when is it an outflow and when is it an inflow of cash. Obviously, the purchase of fixed assets, but remember, cash, only the cash component of the purchase would be reflected in my cash budget. Loan repayments, obviously, if you are repaying the loan or you're repaying the interest on the loan, those would be regarded as payments, outflows of cash. And then obviously your cash purchase of goods, where you are buying goods on a cash basis, clearly you can see money leaving your bank account. So if you look at this receipts and payments, it's basically your bank account. Money is flowing in, receipts, money is flowing out, your payments. What is the importance of a cash budget? The cash budget is an essential tool used to plan and monitor the liquidity of the business enterprise. Now you see another term there, liquidity. Like I explained early on, you do not want to reach a situation where you have cash flow problems, where you have liquidity problems, where the receipts are not sufficient to cover our payments. And that is why we draw up the cash budget. We're still looking at the importance of our cash budget, and we said management can ascertain whether the enterprise will have enough cash. That is the primary objective of your cash budget. Do you have sufficient cash? One, to meet the short-term commitments such as paying creditors and repaying loans. Obviously, your creditors are giving you certain time limits, so you have to meet your commitment within that time limit. Two, the purchase of stock. Clearly, if you are an enterprise that's buying and selling, if you are unable to buy goods, you are unable to sell the goods. So clearly, you should have cash available to buy and purchase goods. Then you have your purchase of additional fixed assets. You may reach a situation where your fixed assets are inadequate and you need to purchase more fixed assets. Now again, your budget here will tell you whether you are allowed to buy those assets or not, depending on the cash available. Budgets will assist us to predict shortfalls, and arrangements can be made with the banks and other sources of funding in advance. In other words, yes, you may have a situation where you're going to need cash. You don't have the cash, but if you make an arrangement with your banks, financial institutes, or other sources of cash in advance, it's often cheaper because you're not forced into a situation where you have to pay a certain amount and you have to pay the interest rate at that time. So obviously when you are negotiating, you're negotiating from a position where you're in a corner. Whereas if you're planning long term and you say, okay, fine, in this month I'm going to need X amount of money, let me make arrangements now for it, so you are planning in advance. And obviously you can see that budgeting improves your decision making. You can decide, okay, in this particular month, we can afford to buy this additional fixed asset. Or in this month, we are not able to buy it because there's a shortfall of cash. But yes, this is what we would anticipate in the next month. So you are making decisions. And grade 11, definitely. When you go to grade 12, and we sincerely hope that very soon you will be a grade 12 learner, you will see the interpretation, although you need to know it in grade 11 as well, but the emphasis in grade 12, in the grade 12 accounting paper, moves to the interpretation of a cash budget, where you now asked to make decisions based on information that you have. Right? We also find that many potential funders will require you to provide a budget in addition to a business plan, particularly if you're a new business. So if you're going for a loan or you're going to buy goods on credit, the service provider will ask you, do you have a budget in place? And obviously, that's one of the requirements when you're going for funding. You can also use it to increase your staff motivation. That means you tell your staff, these are the budgets that we have to meet. Obviously, being part of the enterprise, they would buy in and say, yes, correct, we need to increase our sales, or this is what we need to do. And in this way, we can then meet our targets. A budget must be conservative, achievable, and realistic. Very important. Remember, you're looking at payments should not exceed your receipts. Very important. And after the budget period, the budgeted receipts and payments must be compared with the actual figures. Because what's the point of drawing up a budget if you don't compare it with actual? Because remember, budgeted is forecast, whereas actual is what has transpired. So the comparison between the two is of extreme importance. Okay, what are the important components of my budget? We spoke about receipts, the payments, right? You'll either have a surplus or a shortfall. You'll then have your bank opening balance and your bank closing balance. You know what your receipts are? We've dealt with it. You know what your payments are? We've dealt with it. So the difference between the two will either give you a surplus or a shortfall. And then you had cash in your bank account at the beginning of the month, and obviously the final balance will be your cash in your bank at the end of the month. So that, guys, is now you will see we're getting into more detail with regards to budgets. But don't stray or go away, because when you come back, we're definitely going to do more. See you in a jiffy. Welcome back, Accounting Boffins. Remember, we're busy with cash budget. You with Ashraf Patel and the team. And what are we looking at? We're actually looking at a case study now, right? Let's look at the situation that we have. Adelaide runs a medium-sized enterprise providing emergency services to the local school, right? So that's your scenario. She's been given a period of 4 months to upgrade the staff room, and she was going to be paid after the completion of the job. Now, obviously, this is a scenario based on budgeting. So yes, she's been given a contract, she has to upgrade the staff room, and obviously she'll only be paid on the completion of the project. So what does she do now? Because of the nature of the project, she has to employ 5 extra employees. She needs extra raw material, she needs equipment in order to complete the job within the specified time. So clearly you can see her demands compared to what she was before, and now taking on this new contract, the demands have changed. Okay. 2 months before the completion of the contract, Adelaide started to experience cash flow problems. Now, she's in a situation, she's taken on the contract, 2 months into the contract, alarm bells are ringing. What's happening? She's experiencing cash flow problems. Right. She's exhausted her personal savings, and she's cashed out the fixed investment that she had. So in terms of her own cash resources, she's taken out all her personal savings. She's also had a fixed deposit, which she's pulled out because she needed the money, and now that revenue, those revenues are now exhausted. She needs to pay wages and buy more material. Obviously, Operations have to carry on. She needs to pay the wages. She needs more material. Now what does she do? She has approached the banks for finance, but was not successful. Okay? Like I told you, if you plan in advance, then obviously you have sometimes to negotiate with the banks and the financial institutes. But now she's in a crunch situation. She needs the funds now. She decides to go to the local lenders who charged her 18% interest, which is obviously very high if you compare to the 3.5% that would be charged by the banks. Because remember, these people that provide the finances that you need immediately are going to charge you a very high interest rate. So look at the comparison, 18% to 3.5%. The loan added costs to her business. Obviously, a loan needs to be financed. In other words, you're not going to get the loan and you only have to pay back the loan. No, you're going to have to pay back the loan plus the interest on the loan. She decided, okay, we've done that one. We've done that one already. Let's carry on. Now the question says, 1, provide a list of problems that Adelaide faces as a result of the contract she received from the local school. Okay? So now obviously you now have to identify what challenges will she be faced with. 1, let's look at this here. Obviously, there's an increase in expenditure. As a result of what? She needs to pay wages to the employees. Remember, 5 additional people were employed. So clearly you can see there's an increase in her wage bill. Obviously, the demands of the job, the demands of the contract would be she needs more raw material to complete the upgrade of the staff room. She also has capital expenditure. Look at the new term that we are using here. One was operating expenses, which is wages and salaries and electricity and telephone, etc. Those are operating expenses. But now she has capital expenditure. In other words, she needs to upgrade the equipment in order to complete the contract. Right? So you have capital expenditure in the form of equipment and an additional cost, which is interest expense. Now remember, this is what we call a financing cost because she needs to finance the loan. And as a result of that, there is interest that will have to be paid. Okay. What kind of plan should Adelaide have drawn up before she started the job, and how was this plan going to help her? Clearly, there was no plan in place. And as a result, she's now in the predicament where she has those challenges. She should have drawn up a cash budget. Certainly. Because she should have taken on the contract, taking into consideration, right, this is my budget. This is what I am going to experience. I'm going to need to pay wages. I'm going to need to pay salaries. I need to buy equipment. I need to buy material, etc., etc., etc. The budget could have anticipated or predicted the problems of cash flow because she would have seen in her budget, these are my receipts. These are my projected, anticipated expenses in terms of payments, and clearly there's going to be a shortfall of cash. The next question says, what action was she supposed to take so that she doesn't run out of cash? Provide at least 2 points. Okay, let's look at it. 1, she had to negotiate to buy the supplies on credit. She could negotiate that. She could have gone to her suppliers and said, listen, I've got a new contract. It's not my existing order. There's going to be an increase in the raw materials that I'm going to be buying from you. I need you to supply me those goods on credit. So immediately it would alleviate the problem of having to fork out the cash, which obviously she knew there would be a cash flow problem. So then she could see that the raw material and the equipment could have been bought on credit. Because obviously, by the time the contract was completed, she would then be able to meet her commitments because she would have the cash available. Rearrange the payments so she did not have to borrow money. Absolutely. Make an arrangement with your suppliers, with your creditors, telling them, right, this is my condition, I'm taking on this new contract, I will be able to pay you on these terms here. So in that way, she's planning, right? Apply for a short-term loan from her bank or an overdraft facility. Can you see? If you go timelessly to your bank with your business proposal, explaining to them that this is the contract that I'm going to take on, this is my budget that I have in place. Obviously, when the banks look at that documentation and they look at your plans clearly from their side, you would then expect them to come to the party. And in that way, you would then be able to negotiate a short-term loan with your bank. Okay, so now, if we look at everything that we have done in the lesson on budgets, let's do a recap. 1, we spoke about what is a budget. We've spoken about why it is important to budget. We've also spoken about the different types of budgets in terms of a personal budget, one that you draw up for yourself. We spoke about a household budget, which every household needs to budget. And we've spoken about the importance of that to ensure that we balance the budget within our homes. Can you see? We're moving to different levels of budgeting. Then we also spoke about a business budget. Obviously, that will be the emphasis of the questions that you will be exposed to, is a business budget, obviously. But we also went on and spoke about the national budget in terms of the budget for the country. Now remember something else. The national budget impacts on the business budget, right? And definitely the business budget, being people who work for businesses, people who own businesses, it will impact on your household budget. And yes, the household budget will impact on your personal budget. So can you see the link between all of these? Right. Then we went on, and at length we spoke about the cash budget. Remember what we said? We alluded to this earlier on, that you're going to have a sales budget, you're going to have a purchases budget, you're going to have a capital expenditure budget, but all of these budgets would feed into your cash budget. And the most important aspect of your cash budget is to think cash. In other words, what are we looking at? We're looking at the sources of our cash, namely our receipts. Then we looked at the payments. That means all the money is leaving our bank account. Remember we said your cash receipts less your payments will either give you a surplus or a shortfall. If your receipts are greater than your payments, you're going to have a surplus. But conversely, if your payments are more than your receipts, you're going to have a shortfall, right? So receipts greater than payments, surplus; payments greater than receipts, shortfall. Simple maths. Okay. Then you also looked at your opening balance in your bank account. So that means, and maybe we can just do a quick example here. If my receipts were 10, just a simple example, and my payments were 6, that would give me a surplus of 4, right? Since my receipts are greater than my payments. I now bring in my opening bank balance, which was 3, and therefore you can see my closing bank balance is 7. So this is a very simplified form of what a budget would look like. Obviously, when we get into the other lessons, we'll do the actual detail and look at each item separately. But this is just a very basic and a simple way of understanding what would go into your budgets. Like we said, those are your receipts. You had payments to the value of 6, it could be 6,000,000, 600,000, whatever the figure may be, giving you a surplus of 4. You bring in your opening balance of your bank account, which was 3, to give you a closing balance of 7 in your bank account. So in this way, you can clearly see that when you're doing a budget, think cash. Only cash items would feature in my cash budget. Also taking into consideration that there are certain items that will not feature in your cash budget, and those are your non-cash items. What did we discuss as non-cash items? We looked at bad debts, remember, non-cash item. We looked at depreciation, which we said is an imputed expense, so it's a non-cash item. And yes, there are other non-cash items that would not appear in your cash budget. Okay, so now, if we look at our entire lesson, you will see that the purpose, the ultimate purpose of a budget is to maximize the profits of a business. Because if you don't do that, then obviously you're going to face challenges in terms of meeting your commitments, like critical shortfalls of cash, where you will be unable to buy stock. If you are unable to buy stock, you are unable to sell the stock. If you are unable to have sales, it's going to impact on your profits. So therefore, accounting boffins, what is important to remember that a budget is a planning tool, right? But once you've drawn up a budget, it does not mean that you do not refer to the budget. Remember we said, once you have a budget, you refer to it on a continuous basis in order to ascertain whether you have met the requirements of the budget in terms of your actual figures. Remember, budgeting is a forecast, it's not actual. When you actually have your actual expenses, you are then able to see and make a comparison between your budgeted and your actual, and based on that, you now have to make certain adaptations, you need to make certain decisions whereby you can then make and do what is necessary. The case scenario that we had with regards to Adelaide was a good example of how important it is to draw up a budget. From me, Ashraf Patel, and the team, until the next time, keep on practicing your budgets, keep your feet in the ground, reach for the stars, and be good. Goodbye.